Welcome to another tutorial video. This one is going to be all about the private equity case study. The most common question we get here goes something like this. What should I expect in case studies when I go through the private equity recruiting process? How much time do I get? How detailed does the model need to be? How important is the case study? And what exactly are they looking for? This is very much a tutorial where you need to see the Excel file, the case study prompt, and the actual written documents for the company's filings and the investment recommendation, presentation, and so on. So if you go to mergersandinquisitions.com/private-equity-case-study, you'll see everything there, or you can just Google it and get all the documents like that. But I think you really need to see the written documents to get a lot out of this video because we're not going to be doing all that much in Excel. A lot of it will just be qualitative descriptions and some examples of the sets of steps that we undertake to complete this process. So the short answer here is that there are different types of case studies in private equity interviews. So we need to start with that and discuss what to expect depending on where you're interviewing. For example, you could get something like a paper LBO where you just have to complete a very simple model on paper, or maybe even do it in your head if it's simple enough, and estimate the IRR using very, very rough math and guesstimates. Now, another type is that you could get something like a 1 to 3 hour timed LBO modeling test. And it could be on-site or it could be done remotely via email and Zoom and so on. And this one is really just a speed test. It's about entering the formulas accurately, finishing on time, knowing all your Excel shortcuts, and maybe answering a few simple questions at the end. And then a third type is the take-home LBO model and presentation. This one tends to be much more open-ended. It requires more outside research, and the models aren't necessarily more complex, but you need to make a very good argument and have a lot of data to back up all of your numbers. So we're going to focus on type 3 here, and then maybe in future tutorials or in other videos in this channel, we'll take a look at types 1 and 2 at some point in the future. If you are interviewing with larger private equity funds, or you're interviewing as part of the on-cycle recruiting process in the US, it is most common to get timed LBO modeling tests between 1 and 3 hours with a few simple questions at the end. Now, if you're going through the off-cycle recruiting process, you're targeting smaller to mid-sized funds, or you're outside the US, then open-ended tests, true case studies are more common because they don't care as much about trying to recruit everyone in a single weekend or week or a very short period of time. They're looking for the right candidates. Even if it takes longer, they really want people who can think critically, understand what their fund does, and find matching companies and deals. As I said before, model complexity matters far less than being able to justify your numbers and your investment thesis. So a lot of people approach this and they say, I have a week of time, therefore I should make a very, very complex LBO model. And that is pretty much always the wrong strategy unless they tell you to build a model of a certain complexity. The case study is extremely important because it's often the final step between the interview and the job offer, at least in certain regions and at certain firm types. So it's arguably the most important step in this entire process, and firms view it this way because it's really the best way to measure your abilities. If you can't even complete a simple exercise like this and make an investment recommendation when you have a few days or a week of time, you're not going to be able to do it on the job in private equity when you have a lot more information and a lot more time and resources. This is going to be a longer tutorial, and it needs to be because we're going to walk through the main steps of an entire case study here. So here's the lesson plan, and as always, I'll put the timestamps on the side of this slide. We'll start with the typical case study prompt. We will then go through a suggested time split if you have 1 week to complete it. We'll then go through the process of screening and selecting a company if they don't already tell you which company to model and analyze. Then it's part 4, we will look at how to gather data and do some industry research. In part 5, we'll go through the model itself and show you how to build a simple but effective model that can help you answer the questions without taking a huge amount of time to complete. And then part 6, we'll look at how you might draft an investment recommendation that is 5, 10, maybe even up to 15 slides long, and how it might change depending on the requirements. Let's go to part 1 and talk about the typical case study prompt. So I'm going to pull up the case study prompt that we have right here. You can see that this is a take-home case study, and this is a firm, a middle market private equity firm that invests in the consumer, media, telecom, and software sectors. They're giving us a lot of information, such as the average deal size here, 500 million to $1 billion, but possibly as high as $2 billion for the right opportunity. And they tell us a little bit about the LBO model. We don't need a full 3-statement LBO model. And they want a PowerPoint presentation of 15 to 20 slides with the investment recommendation, a market overview, the strategy overview, some valuation information, the LBO model, and risk factors. Now, I would say this is a pretty typical open-ended case study. They're telling us the types of companies and deals they like, and then they're telling us to go find and research a company, make an investment recommendation, and present it in a short slide deck. Now, sometimes they will give you the specific company and materials like the information memorandum or the company's annual report or the most recent investor presentation. And if they do, that's great. But honestly, in a lot of cases, the instructions tend to be minimal or non-existent. So you're going to have to do all this and find a company on your own, which is itself a challenging part of the process. In terms of the time, 1 week or 7 days is common. It could be a little bit more, like 10 days or even 14 days. It could also be less, like 3 or 4 days, or sometimes even 12 hours if it's closer to a timed modeling test, but we're going to go with the 1 week assumption here. When you get something like this, you have to think about how to split up your time. And the reality is that if you're completing this type of case study, you are probably working or studying full time, which means that you don't have 8 hours or 10 or 12 hours every single day over 7 days to do this. You probably have maybe 2 to 3 hours a day, maybe more like 1 or 2 hours a day. So the suggested time split is as follows. On your first day, so maybe for the first few hours of this, you want to read the case study document, understand the private equity firm strategy, and pick a company to analyze. All of that will probably take up your entire first day because, again, you probably only have a few hours to actually spend time on this. Now, on the second and third days, you want to gather some data on the company's industry, its financial statements, its revenue and expense drivers, and so on by going through its annual filings, investor presentation. You don't need to read every single thing. You're supposed to scan through it and look for key charts and diagrams and numbers that could be useful, but you don't need to read all 573 pages of the annual report to do this. On days 4 through 6, so days 4, 5, and 6 here, you want to build a simple LBO model. I would say between 200 and 300 rows, but you could potentially make it even simpler than that. And you ideally want to use an existing template to save time here. If you try to build your own template from scratch, it's just going to take too long in most cases. So here, if you look at the template that we're using in this case study, it's not really built from scratch. It's built on top of many other examples of LBO modeling templates that we had around, and we just modified it for this specific company. And then on the final day, you want to outline and draft your presentation. You should let the numbers drive your decisions. In other words, the IRR, the internal rate of return and different outcomes. And then you want to support your decisions with the qualitative factors. Let's now go into part 3 and talk about how to screen and select a company here. Now, in this case, according to the case study prompt, the firm wants undervalued companies that are in need of a turnaround in the consumer, media/telecom, and software sectors. The purchase enterprise value should be $500 million to $1 billion, up to $2 billion in some cases. So if we find something bigger than $1 billion, that's fine. We should try to find something smaller, but if we can't, then it's fine to go above that slightly. And then for the strategies, they want to be able to use add-on acquisitions, restructuring, or divestitures to turn the company around. This is important because what it's really telling you is that they're looking for financial opportunities to execute turnaround strategies. They don't want strictly operational turnaround strategies like expanding into a new market or developing a new marketing strategy or something like that. They want to buy new companies. They want to divest divisions that aren't pulling their weight or possibly restructure the company in other ways to make this happen. I would also add a few criteria here. One is that we want companies that have good, consistent free cash flow generation and relatively high free cash flow yield, something like 10 to 20% maybe. The reason for this is that if we're going to be executing a turnaround strategy or add-on acquisitions or restructuring, all those are going to require cash flow. And if the company doesn't have much cash flow on its own, then we're going to have to bet very heavily that there will be multiple expansion between the beginning and end of this deal. It's quite risky to do that. You never really want to bet too heavily on multiple expansion, so we want companies with a good amount of free cash flow. It's better to find companies that trade at relatively lower EBITDA multiples. I would say 5 to 10x is ideal, but we could potentially go up to 10 to 15x if there are solid growth opportunities. The IRR math gets very tough when leverage, debt, is only 1/3 of the total price. And if you go above 15 times EBITDA, you're going to get into that situation because at this point in time, most companies cannot be levered at more than 5 to 6x debt to EBITDA. So it gets very difficult to make the math work when you're acquiring a company for 20x or 25x or 30 times EBITDA. There's also a lot more risk because the multiple is much more likely to fall rapidly in that case. Another criteria that I like to use is that we want reasonably clean financial statements and enough detail for revenue and expense projections. If we don't have that, the case study falls apart because we can't just look at something like a 7-day case study and project revenue based on a simple percentage growth rate, for example. So the steps in the process here are first to do a high-level screen of companies across these sectors based on the industry, market cap or enterprise value, and geography. Then we can review the list, which generated about 200 companies here, and narrow the sector. And then we can narrow it to the top few companies and select one. So here, I'm going to show you the Capital IQ screen. It generated about 231 results. And we have all the companies according to their industry sector, their geography, company type, total enterprise value. So we have a whole list of companies here. And I'm not going to go through all of these, obviously, but a few quick impressions were as follows. Within the software space, a lot of companies had very, very high multiples, and some companies even had negative EBITDA, which means that they're probably not good LBO candidates. That's not to say that all software companies are bad candidates, but for this specific firm and their specific strategy, we didn't see that many good companies that fit the profile within this size range. Just to give you a quick example of this, if we look at this company, MeTech Systems or MyTech Systems, they do have some pretty solid growth rates here, 15, 20, 25% revenue growth. But the company is also trading at very high multiples here of between 20 and 30x EBITDA. We'd say that's too much. Also, if you look at their free cash flow yield, it's not really in that 10 to 20% range that we're seeking. In the consumer retail sector, the companies had more reasonable multiples, but their margins were also quite low and the free cash flow generation wasn't that great. And then in the media and telecom sector, there were quite a few companies with lower multiples, but CapEx was quite high for the telecom companies and free cash flow yields were lower as a result. So once we ruled out all those companies with very high multiples, negative EBITDA, and exorbitant CapEx, that left a set of 7 companies here. And then we went through each of these and applied stricter screening criteria to try to eliminate ones that were still trading at multiples that were too high or that had other problems. For example, some of these companies actually had negative free cash flow, some had very little information on revenue and expenses, some still had very high multiples, or some had businesses that were just declining too much. For example, this one company, Thrive Holdings or Thrive Holdings, had an EBITDA multiple that was pretty low here, around 5 to 6x, which seems good on the surface. But then if you go up and look at their revenue growth, their revenue has been declining by about 20 to 25% over the past few years, and it's projected to keep declining into the future. Now, if you look at the company in more detail, they had one division that was growing and then one bigger division that was declining, but we felt this one would have probably been too much work to finish in the time frame that we had right here. So we ended up settling on Cars.com. It had a 9.4x EBITDA multiple at the time of this analysis. Its business was declining, but it had modest projected growth, so it was more in the stagnant category. It had 25 to 30% EBITDA margins, and the free cash flow yields were between 10 and 15%. Now, if you don't have Capital IQ and you have to do this exercise, you're probably going to have to rely on FinViz and use PE multiples as a proxy for EBITDA multiples. You can click through to individual results and get the price to free cash flow multiples and estimate the free cash flow yield like that. And then in this case, you're not going to be able to look at everything in detail. So maybe narrow it to 2 to 3 candidates and then quickly look at the revenue and expense drivers from there. So that's a little bit about the screening process. Let's now talk about gathering data and doing some of the industry research. Step 1 here is to do a quick scan of the most recent annual report and presentation, look at the financial statements, and find a revenue and expense breakout with the key drivers highlighted. So with Cars.com, for example, if you go to their 10K, it's pretty obvious just from scrolling through that one of the key drivers here is going to be the dealer customers, and then another key driver will be the average monthly revenue or average annual revenue per dealer customer. This company sells its software and marketplace services directly to used and new car dealers. So this is clearly going to be one of the key revenue drivers for this particular company. And if you look in their investor presentation, you can find some information about their website traffic and sources of the traffic and dealer customer growth and the website customer reach and other things like that. So you go through this type of process and try to get a quick impression of the company. Then you have to figure out how you might project these drivers and the outside information you need to do so. So here, for example, with cars.com, one of the things that strikes us is that they do give us the dealer customer numbers, and we can go back further and get more numbers like this, but we don't know what type of market we're dealing with. We don't know the total size of the market or how the company's market share is changing over time, which means that we'll probably need some outside research to get those numbers. So we go and gather and input that outside information, and ideally we want at least 2 to 3 drivers for the company's revenue. And then in step 4, we simplify and input the financial statements. So let's go through each part of this in a little bit more detail now, and I'll show you some of the Excel model and where the numbers are coming from. With the dealer customers, it's probably best to make this a market share projection because the company's customer count keeps falling, but if you look at outside sources, you'll see that the total number of dealers in the US is not really changing by all that much each year. The revenue per dealer figures also barely change. The website traffic keeps growing, but the company isn't really leveraging it properly because its ad revenue keeps falling. So let me show you a couple examples of what I'm referring to here. If we go into the 10K and we just scroll through and get to the financial statements, if you look at the income statement, the company's revenue is falling here from 2018 to 2019 to 2020. So that's already a known fact. But I think the more interesting part is not how they break out the revenue there, but how they do it a little bit later on, where they break it into marketplace subscription advertising, display advertising, and pay per lead. Now, we know the company's traffic to its website is growing substantially, but despite that, its advertising revenue is actually falling. And then with the dealer revenue here, this is also falling, but this makes a little bit more sense because we know their dealer count has been declining or at least somewhat spotty over time. So based on all that, we can look up a couple of sources. We can easily Google the number of new car dealers in the US each year. We can also Google the number of used car dealers in the US each year, and we can get estimated growth rates from articles like these. We get an estimate of the average annualized growth rate, and so we can use some of that in our projections and forecasts for this company. So for example, down here, we look at the total number of dealers in the US, see that it's basically stagnant, maybe growing at a very low percentage growth rate if you add up new and used. And then we looked at the company's market share and found that it was falling from around 14% to about 11 or 12% over the past 3 or 4 years. So based on that, going forward, we set this up and built in multiple scenarios where in each case, the market share is falling. The market is growing very modestly, but in each case, the market share is falling. The main difference is that it holds up a little bit better in the upside and base cases than it does in the downside case. And we just assumed that the average monthly revenue per dealer was rising roughly in line with inflation. It stayed about the same, maybe gone up a little bit historically, so we felt that was a fairly safe assumption. And as I just showed you, you can easily Google terms like used car dealer market US and variations like that. In this case, it was easier to find a breakout of new versus used dealer counts rather than the whole thing together. It's also important to note that this company sells to dealers. So it's not a direct buyer to seller marketplace among consumers like a company such as Carvana. So the business model is very, very dependent on the number of dealers, at least as the company operates right now. Now, you might be looking at some of these projections and saying, okay, so you're saying that the company's customer count will keep falling. And then if you look at the revenue, essentially we're saying that even in the base case, the marketplace subscription advertising revenue is expected to fall or be roughly stagnant over time. So shouldn't we be assuming some type of turnaround here? Why are we assuming that the company's market share here keeps falling? And the answer is that we don't think it's really plausible because the core market is stagnant, the number of dealers isn't changing much, and the momentum is clearly against the company. It's clearly on the side of these direct buyer to seller marketplaces like Carvana. So we think it's more realistic for the company to move into new areas via add-on acquisitions and by monetizing its web traffic more effectively. Now, the other drivers here can be pretty simple percentages of revenue or based on the employee count. The main point is that if we are using add-on acquisitions or a divestiture or something else, then we want to reflect those strategies properly in this model. So here, for example, a lot of these other projections like the annual website traffic are simple percentage growth rates. The display advertising is tied to the number of web visitors, and then the number of web visitors is tied to the company's spending on sales and marketing. And then others like the G&A are just percentages of the company's standalone revenue. So we're not going crazy. We're trying to make fairly sensible, simple assumptions here that let us finish the model and focus on the most important points. In terms of finding add-on acquisition candidates, Capital IQ is really important here. You can screen for companies below a certain size, like say 100 million in enterprise value, and you can use keywords like auto or auto software in the business description to find software and media and car dealership companies that fit this profile. In terms of the financial statements, since they told us that we don't need a full 3-statement model, we're actually skipping the balance sheet altogether. We have an income statement and we have a cash flow statement, and that's about it. We also have the debt schedule, of course, because it is an LBO model, but we're simplifying and skipping quite a bit here, and even the cash flow statement is simplified over what the company has in its filings. Now, the income statement is mostly following what the company does, but we have made one change, which is that we think it's more useful to look at revenue like this, marketplace subscription versus display advertising, pay-per-lead, and other, rather than the treatment that the company uses on its income statement officially. So if you go to the income statement, let's just skip around till we get there, you'll see that they break revenue into retail versus wholesale. We don't think this is super helpful though, so we change that around. But the rest of this, we pretty much follow what is on the company's income statement. Now, on the cash flow statement, if you go down, we kept most of what was in cash flow from operations, but we consolidated some of these items. For example, provision for doubtful accounts doesn't need to be a separate line item. It can easily be consolidated with some of these other smaller items. We also consolidated all of the change in working capital into a single line item here. There's no point listing this separately. We don't even have a balance sheet here, so it's completely pointless, and so we simplified that quite a bit. And then down here, the main change is that we only include CapEx and acquisitions and investing activity, and then we left out financing activities altogether. This doesn't matter because it's an LBO model, so the capital structure will change anyway. And I've just summarized some of what I just said there. You can download this company's financial statements in Excel from the website. I actually prefer that because I don't always like the way that Capital IQ and other services like FactSet list the company's statements and process them automatically. Let's go into part 5 now and talk about how to build a simple but effective model for this case study. Now again, you don't need a full 3-statement model, and honestly, unless they tell you explicitly to build one, it is rarely worth the extra time and effort. It's going to make your model more complex, it'll be harder to fix and change around, and it's not necessary because LBOs are based on cash flow and the EBITDA purchase and exit multiples. So as long as you can track the cash and debt balances and the cash flow, you don't really need the full 3 statements. In terms of model complexity, I would say 200 to 300 rows is a good target. In this case, we get to about 270 rows if you go down to the returns calculations. With the sensitivity tables, this is closer to just over 300 rows, which is okay, but we could probably simplify this a little bit. The key point is that, again, you're not going to get points for a very complex LBO model that takes someone days to understand. No one has that kind of time. They're going to focus on your presentation and your model output. They might glance at it and go through it very briefly, but no one's going to have the time to go into an in-depth 5,000 row model. The most important thing is supporting your numbers with data and being able to cite those sources, and then also making sure you analyze the deal in different scenarios. So here, we're focusing very much on add-on acquisitions as the main strategy, so we pay a lot of attention to them in this particular model. For example, if you go up here to the top, we have different strategies. We have a growth strategy and a value strategy for these add-on acquisition assumptions. And then if you go down and you look at this schedule, we have an entire schedule for the acquisition projections. We assume the company spends about 100 million on these acquisitions each year. That's roughly the amount of free cash flow it has available for these. And then we plot the revenue and the EBITDA contributions from these, and these show up directly on the income statement. We don't focus too much on something like the debt schedule. The debt schedule here is very, very simple because this deal is not really based on financial engineering. This deal is all based on the add-on acquisitions and the company being able to improve its growth rate and boost its EBITDA via those acquisitions. So in short, here we have some simple scenarios. They really only affect the market share and the exit multiples though. We have add-on acquisitions, we have an income statement and a partial cash flow statement and a very simple debt schedule. In terms of what we could drop, I don't think the growth versus value options here are actually all that important. We could probably condense these into one single option instead and sort of combine these two scenarios. Also, even though we build in support for an M&A versus an IPO exit, I don't think this is all that important either. The multiples are slightly higher with the IPO exit, but it takes more time to sell the stake. The M&A scenario has slightly lower multiples, but the stake is sold right away. Although it's interesting to look at, ultimately it doesn't really affect the investment decision all that much. So we could drop this if we were pressed for time or had only 5 or 6 days or something like that. It would be harder to drop the scenarios and the sensitivity tables, even the short, simple ones here. We're making an investment decision, which means that we need to think about all the outcomes, or at least a range of outcomes. And even if we're recommending investment in the company, we need to at least think about what could go wrong and how to protect ourselves if something really bad happens. If you don't have months to prepare and an entire team to support you, sensitivities and scenarios are the best way to do this with only a few hours or a few days to work with. Let's now talk about the last part here, which is drafting the investment recommendation. For a 15-slide investment recommendation, which matches what the case study told us to do, they said directly right here, 15 to 20 slides. So we're going with the lower end of that, 15. I would suggest something like this. Slides 1 to 2 can be a recommendation for or against the deal. You can set out your criteria and say why you selected this company. If you go to our recommendation, we have this cover page first, and then we recommend acquiring the company. We give the targeted returns and then the likely returns, and we give all the reasons why we're recommending in favor of it in terms of the valuation, the growth potential. We then go through why we selected Cars.com over these other potential candidates and go through the EBITDA margins, the free cash flow yields, the multiples, and so on and so forth. Now on slides 3 to 7, you go through the qualitative factors that support or refute the deal. So you talk about things like the market, the competition, and growth opportunities. Here, for example, we start out with an overview of the company's historical performance. Then we talk about the market overview and the car dealerships in the US. And we talk about growth opportunities, namely selling additional software and services to dealers and then monetizing the company's growing website traffic more effectively. It seems ridiculous that the traffic is growing so much, but they're actually earning less and less from that traffic over time. And then we go through the proposed turnaround strategy. So we have to stabilize the core business and then become a platform company via add-on acquisitions. We then list some of these add-on acquisition candidates, and then the next part gets into the numbers. I would say slides 8 through 13 can be all about the numbers. We want to summarize the LBO model, then go through the multiples versus the comparables without going through a full detailed valuation. So we list the company's 4-year price volume graph right here to make the point that yes, we're paying a 30% premium, but relative to what the company was valued at in, say, the 2 oldest historical years, this still seems like a pretty good deal. We give some information about the multiples over there. We summarize the scenarios in this model, and then we summarize the LBO modeling assumptions, give some of the output with a few of these sensitivity tables, and make the point that here, with the different scenarios, essentially, even in the base case, we're going to get to at least a 20% IRR. The upside case seems like a 30% IRR, and in the downside case, we at least avoid losing money because the IRR remains above 0%. So that's the next section here. And then we go through some of these tables with the impact of the add-on acquisitions. And then we talk about the downside case and the potential to lose money at the end. The next slide is about the risk factors. You always need to consider these in a positive recommendation, and a negative recommendation, you might give the counterfactual and say what might change your mind about the deal. So here we talk about how the add-on acquisitions might be more expensive, the company's market share might decline more rapidly than we expect, or the company's EBITDA margins might fall or fail to return to their historical levels before the past few years, which saw a big disruption in their business because of the pandemic. So we discussed these and possible ways to mitigate them on this slide. And then on the last slide, we just restate the conclusions from slide 1 and present the best arguments. One trick here is that we make it more visually appealing, so it seems a little bit different, but really we're basically repeating the same points from slide 1 and maybe incorporating a bit more of the numbers throughout. Now, reading all this, you might now be wondering, that's fine, I understand the structure, but how do we actually make a decision here? And the truth is it could go either way, because the numbers look fine in the base and upside and downside cases, as I just showed you, but they're also very dependent on finding at least 5 very good acquisition candidates that meet specific financial criteria in terms of EBITDA multiples and growth rates. And the issue with this is that if we go down and just take a quick glance at these tables, I'll just set calculations to automatic so these update automatically. If we go in and we say that the company's not going to make any add-on acquisitions, we set this to 0, and then we go down to the tables, the IRR instantly falls to more like the 10 to 15% range in the base case. So this deal is very, very dependent on these add-on acquisitions. Without them, the deal simply doesn't work. So all of this comes down to whether or not we think the numbers that we proposed are credible. So if there are actually 5 to 10 or more good deals that can be done at these prices, we recommend the deal. But if we're more skeptical or we can't find good data on these companies, we can easily decide against this deal. In this case, we say yes, but in my opinion, the supporting data for these smaller companies is not that strong. For example, let's just go back to the page with the add-on acquisitions and I'll show you what I'm referring to. We do list some representative acquisition candidates here, but most of these companies are much smaller than what we proposed in the model. So an average individual car dealer, if you go in and acquire these for 5 or 10 million each, you're going to need to acquire a lot of individual dealers to actually spend 100 million on acquisitions each year. Something like America's Car Mart might potentially be interesting, but you're probably looking at spending $1 billion just on that. A lot of these companies are too small or too big, and there are some like NetSol that fit into this very specific niche of offering software to auto dealers, but they're not that common, and we don't think there are actually all that many out there that can actually be acquired at a reasonable EBITDA multiple. So this deal really comes down to your interpretation of this data and how compelling you think the add-on acquisition candidates are. We say yes, but in real life, I think this deal would be difficult to push through unless we were able to find a lot more of these companies that were willing to be acquired. We're at the end, so let's do a recap and summary. In part 1, we discussed the typical case study prompt and how it is often very open-ended. They're not going to tell you much aside from their strategy and what the requirements are, but picking the company and everything like that are up to you. We then went through the suggested time split on days 1 through 7 for a 1-week case study. And the key point really is that you need to spend at least as much time on the industry research, data gathering, and presentation as you do on the Excel model. Then we went through how you screen and select for a company and all the companies we found on Capital IQ and how we narrowed some of them and just ignored certain sectors like software because the multiples seemed too high, the IRR math didn't work. We then narrowed the companies and eliminated some like Thrive Holdings that were a little bit more difficult and that would probably require too much time for the specific case study. Then I showed you the data gathering and the industry research process and how we used much of that to fill in the key drivers in this model, such as the company's market share and the number of used and new car dealers in the US. Then we went through the model, not in detail, but at a high level, how we have some simple drivers, a lot of focus on the add-on acquisitions, an income statement and partial cash flow statement, a fairly simple debt schedule, and also a fairly simple returns calculation, the only real twist being the M&A versus IPO exit options. And then finally, we went through the investment recommendation, the key sections, and how to actually make a decision here. That's it for this tutorial. Hopefully now you know a little bit more about how to tackle these types of open-ended case studies in private equity interviews.